Insurance was invented to spread risk across many people, so no one person gets destroyed by bad luck. That's the theory. But somewhere along the way, it transformed into something else entirely. Now the people who need protection the most pay the highest prices for the worst coverage, and the people who need it least get it almost for free. This inversion isn't a market failure, it's the market working exactly as intended. Let me explain what happened. The original idea behind insurance is beautiful in its simplicity. 1,000 farmers each contribute a small amount to a shared pool. When one farmer's barn burns down, the pool pays to rebuild it. No single farmer is destroyed by one catastrophic event. The risk is distributed across everyone. This is mutual aid, this is collective protection, but notice something important about this model. It only works if the insurance pool is designed to pay out claims. The goal is protection, not profit. Everyone contributes. Everyone is covered. The system exists to serve the people in it. Now let me show you what insurance became. Insurance companies are publicly traded corporations. They have shareholders. Those shareholders expect returns, and returns come from profit. So the insurance company has two opposing pressures: collect premiums from customers, pay claims to customers. The more they collect and the less they pay, the higher the profit. The higher the profit, the higher the stock price. The higher the stock price, the happier the shareholders. Do you see the problem? Protection and profit are inversely related. Every dollar paid out in claims is a dollar not going to shareholders. Every claim denied is profit protected. The incentive structure has fundamentally changed. The original insurance model served customers. The corporate insurance model serves shareholders. And customers are now the mechanism for extracting profit, not the beneficiaries of protection. This is not a conspiracy. This is just capitalism applied to insurance. And it creates a very specific outcome. Let me show you how this works in practice. If you're poor and you need car insurance, you're going to pay more than someone who's rich. Why? Because insurance companies have data showing that poor people file more claims. They live in higher crime areas. They drive older cars that break down more often. They work longer hours and drive tired. They can't afford preventive maintenance, so statistically, they're higher risk. The insurance company looks at this data and says, we need to charge higher premiums to cover the higher expected payout. This sounds rational. This sounds fair, but think about what this actually means. The person who needs financial protection the most, the person who would be destroyed by an unexpected car repair or medical bill, that person pays the highest price for insurance. Meanwhile, the person who could easily afford to pay out of pocket, the person who has savings and assets and a safety net, that person gets the lowest price. The system charges more to the people who can afford it least, and charges less to the people who need it least. This is not spreading risk. This is concentrating it. The entire premise has inverted, but it gets worse. Let me tell you what happens when a poor person actually files a claim. The insurance company doesn't just pay it, they investigate. They look for any reason to deny coverage, pre-existing condition, missed disclosure, policy exclusion, late payment, anything. Why? Because every claim denied is profit saved. And the poor person filing the claim, they probably can't afford a lawyer to fight the denial. They can't spend months in arbitration. They need the money now, so they give up. They eat the cost themselves, and the insurance company keeps the premiums they've been paying. Now let me show you what happens when a rich person files a claim. Rich person has a lawyer on retainer. Rich person knows how to document everything. Rich person has accountants who structured the policy correctly. Rich person files a claim, and the insurance company knows that fighting it will cost more than just paying it. So they pay, quickly, without hassle. Same insurance company, different treatment, because the cost of denying the rich person's claim is higher than the cost of paying it. But the cost of denying the poor person's claim is lower than the cost of paying it. So the poor person gets denied. The rich person gets paid. This is rational behavior by the insurance company. They're optimizing for profit. And profit optimization means paying claims only when you have to. Now let me show you something even more disturbing. Health insurance, the place where this inversion becomes lethal. You pay premiums every month. You get sick, you go to the doctor. The doctor says you need treatment. The insurance company says, no, that treatment isn't covered. Or they say yes, but your deductible is so high, you have to pay the first $5,000 yourself. Or they say yes to the treatment, but no to the specific hospital or doctor. Or they approve it, but then send you a bill months later saying actually it wasn't covered after all. You're paying for protection. But when you need protection, the protection isn't there. And if you're poor, you can't fight it. You can't hire lawyers. You can't appeal. You can't switch insurance companies because you got insurance through your employer. And your employer only offers one plan. So what do? You skip the treatment. You hope it gets better on its own. You ration your medication. You wait until it's an emergency and then go to the emergency room where they have to treat you by law. And then you get a bill you can't pay and your credit is destroyed. And now you're even poorer than before. The insurance company collected premiums from you for years. And when you finally needed them, they found a way to not pay. And you're worse off than if you'd had no insurance at all, because at least then you wouldn't have been paying premiums. This is extraction. You're being mined for profit. The insurance company isn't protecting you. It's extracting wealth from you while providing the minimum legally required service. Now let me show you how rich people use insurance. Rich people don't use insurance for protection. They use it for optimization, tax optimization, asset protection, estate planning. Let me give you examples. Rich person buys a life insurance policy, but not a normal life insurance policy. A whole life policy with cash value. Why? Because it's a tax-advantaged investment vehicle. The cash value grows tax-free. You can borrow against it tax-free. And when you die, the payout to your heirs is tax-free. You're not buying protection. You're buying a tax shelter that happens to be structured as insurance. Or a rich person owns a business. They buy key person insurance on themselves. If they die, the business gets a payout. But here's what actually happens. The premiums are paid by the business, which reduces taxable income. The payout goes to the business, which can be structured to avoid estate taxes. You're not insuring against risk. You're using insurance as a wealth transfer mechanism. Or a rich person has assets, real estate, investments, collectibles. They buy umbrella liability insurance, not because they're worried about being sued, but because if they are sued, the insurance company's lawyers will defend them. They're buying legal protection on retainer. The insurance company becomes their legal department. Do you see the difference? Poor people buy insurance, hoping it will protect them when something bad happens. Rich people buy insurance knowing exactly how to use it as a financial instrument. Same word, completely different function. And here's the key insight. The insurance industry needs both groups. They need poor people to overpay for underprotection because that's where the profit extraction happens. And they need rich people to underpay for overprotection because that's where the legitimacy comes from. If insurance companies only served poor people, everyone would see it's a scam. But because they also serve rich people and rich people get good service, the system appears fair. Rich people say insurance works great. Poor people blame themselves for not understanding their policy or not being able to afford better coverage. The system is designed to appear universal while functioning selectively. Now let me give you another example. Disability insurance. If you're a surgeon and you buy disability insurance, the policy will cover you if you can't perform surgery anymore. Very specific. If you hurt your hand and can't operate, but you can still teach or consult, you still get paid. The policy is designed to protect your specific earning capacity. If you're a warehouse worker and you buy disability insurance, the policy will only pay if you can't do any job, not just warehouse work, any job. If you hurt your back and can't lift boxes anymore, but you could theoretically work a desk job, no payout. Even though desk jobs don't pay enough to replace your income and you have no experience getting hired for them. Same product, disability insurance, but structured completely differently based on income level. The high earner gets specific protection. The low earner gets almost no protection. And both pay premiums. Now let me show you what happened historically to create this inversion. Insurance used to be mutual. Mutual insurance companies were owned by policyholders, not shareholders. Profits went back to policyholders as dividends or reduced premiums. The incentive was to provide good coverage at low cost because the customers were the owners. And insurance companies demutualized. They converted from mutual companies to publicly traded corporations. Policyholders stopped being owners. Shareholders became owners. And the incentive structure flipped. Now the goal was profit maximization, not customer service. This happened across the industry. Life insurance, health insurance, property insurance, all demutualized, all became profit-driven. And the people running these companies weren't betraying the mission. They were following the new mission. Serve shareholders, not policyholders. This is why insurance transformed from protection to extraction. The ownership structure changed. The incentives changed. The outcomes changed. But the marketing stayed the same. Insurance companies still advertise protection, safety, peace of mind, because they need you to keep paying premiums. But the actual function of the industry has inverted. Now let me tell you why the system is stable, why it doesn't collapse, even though it's clearly not serving most people. First, insurance is mandatory in many cases. Car insurance is legally required. Health insurance is legally required or heavily penalized. Homeowners insurance is required by mortgage lenders. So you can't opt out. You have to participate in a system that extracts from you. Second, insurance is complicated. Policies are hundreds of pages, written in legal language, full of exclusions and conditions. Most people don't understand what they're buying. They just know they're supposed to have it. And this complexity is a feature, not a bug. The more complicated the policy, the more reasons the insurance company has to deny claims. Third, the cost is spread out. You pay monthly premiums, small amounts, affordable amounts. You don't see the total cost adding up over years, and you don't see what you're not getting because you only find out coverage is denied when you file a claim. By then, you've already paid years of premiums, sunk cost. You keep paying because stopping means losing the protection you think you have. Fourth, there's no alternative. You can switch insurance companies, but they all operate the same way. They all optimize for profit. They all deny claims. Shopping around might save you a few dollars on premiums, but it doesn't change the fundamental structure. You're still participating in an extraction system. And finally, the people who benefit from insurance, rich people with good coverage, they defend the system. They say insurance works fine. They say people just need to read their policies. They say the problem is personal responsibility, not structural design. Because rich people have credibility, their experience gets weighted more heavily than the experience of poor people who get denied claims. So the system appears legitimate even as it extracts wealth from the bottom and concentrates it at the top. Let me show you the final piece. What insurance companies do with the premiums you pay. You might think they hold your premiums in an account, earning a little interest, waiting to pay your claim if needed. That's not what happens. Insurance companies invest your premiums. They put the money into stocks, bonds, real estate. They're running an investment fund using your money, and they keep the returns. So you pay premiums. The insurance company invests that money. The investments generate returns. Those returns go to shareholders. And if you file a claim, the insurance company tries to deny it to protect those returns. You're funding their investment portfolio and getting nothing in exchange except the promise of protection they'll try very hard not to provide. This is why insurance is one of the most profitable industries. They collect money from millions of people, invest it, keep the returns, and pay out as little as possible in claims. It's a wealth extraction machine operating under the cover of protection. Now you understand the inversion. Insurance started as collective risk pooling. Everyone contributes, everyone is protected, but it transformed into corporate profit extraction. The people who need protection most pay the most and get the least. The people who need protection least pay the least and get the most. And the insurance companies extract the difference. This isn't a broken system. This is the system working as designed. Designed to maximize profit, designed to serve shareholders, designed to extract wealth from people who can't afford to fight back, and designed to appear legitimate by serving rich people well enough that they defend it. The original purpose, spreading risk so no one is destroyed by bad luck, that purpose still exists in the marketing. But the actual function has inverted. Now insurance concentrates risk on the people least able to bear it, and transfers wealth from those people to shareholders. You're not buying protection. You're paying for the privilege of being extracted from. And the system is stable because you're required to participate. It's too complicated to understand. And the people it serves well are the people with enough power to defend it. That's how protection becomes extraction, not through malice, not through conspiracy, just through incentives. Change the ownership structure and the purpose inverts. The mechanism stays the same. The marketing stays the same. But the function transforms completely, and now you can't unsee it.